Welcome to the session called The Deal Makers. My name is Charles Human. I manage the HVS operations in Europe. So we've got on the panel, we've got a representative of a REIT, a broker.
Advisor.
Broker.
Broker, advisor, agent.
Depends who's in the room.
Trusted advisor.
Whatever makes money.
Definitely not trusted. Private equity and operator, stroke investor, and I fall into that broker advisor camp as well. So from the end, we've got David Ling, who is head of strategic development at CDL Hospitality Trusts, Giorgio Manenti, managing director of Eastdil Secured, Camille Yazbek, partner investment director, hospitality and leisure at Patron Capital, and Gaurav Bhushan, global chief development officer at Accor. So let me just give a few data points to set the scene. So last year in Europe was a record year for hotel transaction activity, 24 billion euros total deal volume across Europe. That was up a staggering 65% on 2014, which in itself was up substantially on the year before. So previous peak, 2006, was 20 billion. So we've now quite a bit surpassed previous peak. And that was all driven by portfolios. So 60% of total deal volume was portfolios. 48% of total was in the UK. And that's not dissimilar to the past 5 years, very much a UK-led market. And we'll discuss why. So here's a couple of other interesting data points. So globally, hotels as a percentage of total real estate transaction volume, back in 2007, the figure was 2%. 2% of all transaction volume was hotels. That's gone up to 10% in 2015, which just shows how hotels have become core real estate. Here's another one. So in the US last year, 15% of total hotel transaction volume was cross-border. So foreign investors investing into the US, only 15%. The equivalent figure for Europe was 60%. So very different dynamic, and I think that's been typical of this period in the cycle. So very, very upbeat, very positive last year. We found ourselves coming to this year with a few macro uncertainties. So I'll kick off with Giorgio. So last year was very much the year of the UK portfolio deal, and I know you were involved in a number of those. Why don't you just give us your very high-level thoughts as to where the market was last year and how you see things going into this year?
Yeah, welcome. Nice to have you all. We're a lot taller than we look. The chairs are super low, so I don't know what's going on. But anyway, look, last year, to Charles' point, record year, 24 billion of transactions, really driven by the PE guys buying portfolios. The main reason, probably we think, at least, of this accelerated attention towards our sector was the displacement, really, of the debt cost. So, offices were trading at probably just a 25 to 50 pips discount to hotels, which had 300 basis points, on the cap rate. That made hotels incredibly attractive. And, you see what Apollo did, the Cerberus, the Lone Stars, big buys. A lot of them with projects to IPOs, which will never happen. And then, what happened is they will retell them probably in the next couple of years. Then we all went on holiday, at least some of us, and then we came back to a different world. And the reason is, again, the debt spreads in the US with the CMBS market widened tremendously. The IBs, which were lending to everybody in Europe, started to pricing outside of the market. So PEs became instantly net sellers. And, European REITs, high net worths, and sovereigns really found the space to operate. We're seeing it now already. We called for offers on the Méridien Étoile, biggest hotel in France. We had 22 bids for it, and the top 10 bidders are or French or sovereign institutions, no PE. So again, a really, really good data point to show a little bit how things have changed. Broadly, we think this is going to be a very exciting year. A lot of bolt-ons, a lot of retailing, a lot of spin-offs. Transaction volumes, though, will probably be lower than last year, but probably more hotels will be sold. It's just that we don't see a lot of these massive deals coming along. The high leverage points is tricky, but the balance sheet lenders, the clearers are still there. So we think if you're a moderate levered investor, again, a REIT, a sovereign, and you sort of float around the 50s to 60s, you're going to have fun. We're working on the park in here on Alexanderplatz, and we're getting 70% financing inside of 200 basis points. So again, there certainly is that for gros porteurs, as they call them in France, or for big boxes for everybody else.
Camille, why don't you give the private equity view of what you've been up to?
So I think what Georgia has said is absolutely correct.
Oh, thank you, Kevin.
100%. However, we have been, obviously private equity, the model is quite known by a lot of people, but just to put it back into perspective, we normally look at hotels, portfolios, depending on how big your fund is. So we have 5 funds. We just raised our Fund 5 in Patron. It's around 650 million, which is fresh capital to deploy throughout Europe. We're pan-European. We think we're going to finish around the billion, which is the Fund 4, where it finished also. Hotels are core, and it's become more and more core, as you said. And the reason for that is the medium-term outlook for profit is quite good. With regards to, if you compare it to other asset classes, quite risky because it's very management-driven, and hence we have to make sure that we have the right management. But from the perspective of lenders, it offers high yield relative to other asset classes, etc. So what have we been up to? We've been obviously very active to look at buying the right opportunities. We have been very active selling the deals that we have had in 2012, 2013, and before that. So last year we sold the Jupiter Hotels, which is 26 Mercures in regional UK. Again, the business model was we bought them from Ramada Jarvis out of the administration. We put in the Mercure brand on top. We had the right management, put value enhancement, capex, added new keys, etc. And we sold it to a longer-term buyer from Asia who is looking to have a management platform here and bolt on more hotels and obviously take on the dream for a longer-term hold. So this is the perfect type of private equity deal that we would do. We can also do other type of deals, which is single assets, like we backed Cycus Management for Staybridge Suites in Stratford City, so for the Olympic Games. And we sold that just after that. We flipped it very quickly. That was a development, which is a bit unusual for us, but it was a very quick development for the Olympic Games. And recently, they just also bought our stake in Staybridge Suites in Liverpool, which is also another way of looking at it from private equity perspective. It doesn't have to be the Asian buyer. It doesn't have to be another private equity. It could also be the management team, because within the time frame that we've had it, they've also multiplied their management throughout, and they have many management contracts now, so they've been able to take that on board.
Are you calling the top of the UK market?
At the top of the UK market.
You've now exited everything in the UK?
Actually, we haven't exited everything because we still have luxury family hotels, which is some hotels from the old Van Essen Group. It's in regional UK, southwest. We also have the Spencer Hotel in Dublin, which used to be the old Clarion IFSC. So, and obviously we have Generator Hostels, which is pan-European and growing. We actually now have 9 open plus 4 in the pipeline. That's 7,000 beds throughout Europe, and we'll finish around 9,000 beds as it stands. So are we at the top of the market? Not really. There's still opportunities out there, but there's a gap between what the buyers want and the sellers want.
We hear that every year.
But the gap has increased. And the reason, also Georgia has touched on it also, but you need to look at it if you're a private equity coming to hold for 3 to 5 years and sell, or you are a longer-term player who's taking something which is close to stabilized or can add on more and more and take it further for, a new increased opportunity. So for example, Generator, we've created a brand, and when you create a brand, it takes a long time. And there was a small opportunity in the market, which is very niche, All the brands didn't really look at the student type accommodation. All the backpackers 18 to 28 don't have a lot of money, so they won't spend more than 25 euros. The budget hotels were actually selling more than 3-star, sometimes 4-star, so it's all about location. So we found this concept and we branded it and expanded it. And it's really where you can share, it's the shared accommodation. So you can put in 4 people in one room at 25 euros, you get an average rate, which is a 3-star average rate, you're at 90% occupancy, and most of them, they would stay in and eat within at a good budget. So I don't know how much is that worth in the UK, but I think it's worth a good brand. And whoever wants to take it forward. Does that answer your question, Charles?
Very good. Okay. So David, I think you're the long-term investor, aren't you? You've two assets in the UK last year. Is that what you've bought?
Yeah.
So, I mean, tell us about those and what your strategy is.
Okay. Last year, actually, one is with the REIT and the other one is with our parent company. We bought into the Cambridge City Hotel. If I can take a step back, why are we investing in Europe? I think that's probably, as a REIT, we found that it is really a diversification play. Really, if you look around in Asia, hotel real estate cycle goes very different from Europe. So if I could paint it in a macro picture, Asia's actually had a good run over the last 10 years and is now, I would say, peak. I got to be careful, Gaurav want me to. So it's up there, and some markets now experiencing headwinds. For instance, Singapore, RevPAR is actually easing back after a good 10, 12 years of increase. So where do you find good deals? And Europe is really the place that we felt that has a good growth story ahead of us. So it's really buying in here. Actually, Cambridge actually fit in very nicely when some of our Singapore hotels are easing back in terms of income. So the European hotels fit in nicely, so it gives a very good support for that. And Cambridge, we're very happy about the acquisition. Actually, year-on-year RevPAR went up by 20.6%. So who says UK is only single digit? It can go by a double digit if you find the right deal. Of course, we have our friendly partner, Hilton, who's done a good job as well in driving that. So that's that. Early on in the year, of course, MNC bought into the Hard Day's Night Hotel in Liverpool. Again, we saw good value there. It is a small acquisition, but then, you will make, I think, for 120 to 130,000 pounds a room for a hotel of that nature right in the town center. That's good value to us, and MNC is running that. That's.
So give us a yield comparative. So UK versus Singapore or Asia. So you find Europe attractive. You bought Cambridge. I don't know whether you could say off a cap rate of
close to 6%.
Close to 6.
Just shy of 6. Yeah.
And equivalent in back in your backyard would be.
Okay, I'll paint the Asia picture. Gaurav, you can fill in as well if you find anything else. Really, yield in Asia is really very trading at, I would say, relatively lower. If Singapore, you're talking about cap rate of 4%. Japan, 3.5% to 4%, depending on whether it's inside Tokyo CBD or outside. Hong Kong as well, you're trading at 4.5% cap rate. Korea, because of higher interest rate environment, you're probably looking at 5.5% cap rate. So again, and China is really difficult to say. It's kind of at a stage whereby there's a lot of interest, but the type of deals that are coming out, I think is still, I would say, overpriced at this juncture. Of course, one place in Asia that is pretty cool, Asia Pac is still very good for us is actually Australia. You can still get 5.5 cap in Sydney and possibly touching 6 in Melbourne. So here it is. Cambridge gives us 5.9% on entry. Yeah.
So Gaurav, put your Hotel Invest hat on and explain what you've been up to and what the strategy and thinking is there in different parts of the world.
I better be careful what I say because I got the head of Hotel Invest right here.
I see, yeah.
No, I think, to follow on from what some of these gentlemen have said, as you mentioned yourself, there's been a huge increase in hotel investment. And there's some fairly logical reasons behind that. And when you look particularly at the UK, which has been a significant part of that, a big chunk of that has been overseas capital, cross-border capital, coming largely out of Asia and some in the Middle East. And for me, there's 2 or 3 key reasons. One is obviously debt is now available, as Giorgio said, and it's plentiful and it's cheap, which is attractive. There's been, as David said, significant yield compression in Asia. And there is an enormous amount of money sitting in Asia which has been generated through high net worth family offices and institutions over the last 10 years. I mean, you're talking about, when you start to talk about retail and office in prime markets, you're talking about sub-3 cap rates. So hotels suddenly become a fairly attractive asset class. So hotels have now got compressed to a huge extent in Asia, which is why people like David and other high net worths are starting to look to Europe because it's a very logical place. Asians have an affinity to Europe. They like the UK in particular, so they are moving towards Europe because it's purely a yield play. And it's an attractive yield play, relatively speaking. The other thing we've got to keep in mind is that the type of capital, which is now quite significant coming out of Asia, has a very different or blurred, sometimes, cost of capital and a time horizon. So the typical kind of 3 to 5 year exit is, which from a Western perspective is typically what people like Camilla are looking at. I mean, a lot of the investors, particularly the private investors, are coming with a very significant time horizon, long-term holds. They're willing to go into much lower yields because they're betting on taking a 10, 20, 30-year bet. So it's a very different way of analyzing investments. And it's a very different type of investor, which I don't think we've seen in significant volume either in Europe or the US. But it's there. It'll continue to come. As David said, Asia is going through a very tough time. It's actually a very peculiar time because you've got tough trading conditions, but you've got very, very aggressive yields at the moment because there's an enormous weight of capital. There's a lot of money chasing any quality assets. You'll have 20, 30 serious bids. Used to be 3, 5, 7 before. So that money is now trying to find a home elsewhere. And so for me, the combination of cheap debt and a large volume of cross-border capital is what's causing, obviously, a lot of the activity in Europe, and particularly in the UK.
So now, but how deep is that market? So we roughly calculated that in the UK, over the last 2 years, something like 25-30% of chain hotels have changed hands. Mm-hmm. And that most of that is now in the hands of short-term owners. Yeah. A couple have successfully exited to Asian money. You have, so have Goldman. So I think there's a hope that there's a strong wave coming behind. Is that, and the question for all of you really, is that coming? For regional UK and actually the rest of Europe, I mean, how deep is that Chinese money, Asian market?
Well, I think it's pretty deep. I think you're just
for the mega deals as well as the
absolutely. Yeah. And you've already seen the mega deals in the US. It's just that there haven't been any mega deals available in Europe yet, but they're starting to come. I think you'll find that capital is very, very deep, and it'll continue to come. It just depends on how the market trades, and the availability of quality assets is key. So the capital is there. It just depends on what deals come onto the market.
Look, we've struggled a lot with Asian capital because it's true it's there and there's plenty of it, but man, they're tough. They don't want to pay up. So, you have...
That's why they have the capital.
Yeah, so it's all great, and we all portray the story. But, with the REITs, especially, because they basically have to do an OpCo-PropCo structure, effectively everything below 7% doesn't work, right? Because to give you 5.5%, I got to pay the operator something. And
you wouldn't agree with that, David, right?
No, I wouldn't agree with that.
But so basically, your entry yield actually for the cash flow is around 7, no? Mm-hmm. So they're out there, and we have now put the Atlas portfolio, the 47 Holiday Inns in the UK, under offer, and we have huge amount of interest from Asian buyers. But the challenge was actually to find enough room in that cash flow to structure the deal how it works for the REIT, because a little bit like German open-ended funds, they're not too keen on employees, no. And then there's the unicorn sphere when like when we met Mr. Anbang, Chairman Wu, who bought the Waldorf from us for close to 2 billion, and we recently just awarded a trophy hotel in Paris to an Asian high net worth individual, and again you do have those unicorns floating around, but it's a bit hit and miss. You never know when you catch them, no? It's like, it's like a Ferrari. They're buying a car. So if they go past it, they'll buy it. But if they don't actually get past, they'll never fall in love with it, no? So it's very tricky. But, our view on basically that part of the world is it's an incredibly sophisticated investor. It's an investor which does very, very smart deals. So if you have something sizable with cash flow, you certainly can get them excited. But please don't think for 1 second that they'll buy something at a stupid price just because they're the first-time buyers. Just they're very well advised. They certainly know what they're doing.
Yeah. What's your view, David? You've
Man, I give you a little hook there.
Thank you for that. Yeah.
What's your view? I mean, not just from a CDL, but you know the Chinese market well. Do you see this wave coming?
I think the money is still there, but again, the other factor is really the lack of, should I call it lack of experience in investing overseas. The interest is there, to get all excited, not just Chinese, Asian investors, those who are, if I call it, less experienced. So they will come and look at it, but along the way, if they're not aware of things like tax and other things, you trip them over. So that's why deals sometimes don't get done because of reasons, for various reasons. Yeah, but I believe what's happening in the global markets now. I think the interest is still there, and I'm sure there are some groups that are affected by the economic slowdown. But on the other hand, you can see that there's still sizable market. There's interest is still there from institutional to private equity and so on. They're still there wanting to come and invest in it.
From where? From
Asia, basically.
But more specifically?
I would say again, if it's from China, it's more likely they have the capacity to do the mega deals. Whereas if you look at more Hong Kong or Singapore interests, you'll find that they may go for some trophy assets, but more single assets. They like to pick and choose, typically. Yeah.
What changes have you all seen in the market this year? Now that we've got some stock market jitters, we've got a falling but now rising yen oil price, we've got negative interest rates in certain markets. I think what we're seeing is an increase in single asset deal flow. We're seeing buyers that bought well in the early upswing, looking to kind of not to profit take whilst the going is good. We're hearing from our colleagues in the US that the market there has seen quite a significant impact. So do you agree more deal flow, better value in any markets?
Right?
Are you sure?
I think the deal flow, the UK is now a little bit dry. I mean, there's not a lot of opportunities anymore there. The groups that had opportunistic, at least for us, have all been sold and now being, rebranded or repositioned. There's a lot of opportunity, obviously, in Spain, Italy, although it's very hard to do the business there very quickly. But it's going to be very opportunistic from that perspective for those guys who know or who have teams on the ground. Now, that also touches on the point that David was talking about. From our experience, I mean, if we were to invest, we only invest in Europe. But if we were to invest in China or Singapore, we need to be educated how to do it. So I think the major opportunity that, the major challenges that we've had, for example, when we were selling some of the portfolios to Chinese or to Asians in general was, where is Newbury? I mean, who's going to buy a hotel in Newbury, right?
I live there, actually. So
Is there something called Newbury, right? So people would know London, they would know maybe some of the major cities, but it's very, very important to educate and to understand that they are paying the right yields in these cities and what is the opportunity afterwards to increase their cash on cash.
Yeah, but Gaurav, you want to go first?
Yeah, I think it's as you said, it's a matter of educating them. But a couple of years ago, you asked Asian investors. Of course, everyone wants to be in London and Paris, but there's far and few deals in between London and Paris, and yields have compressed to some pretty significant levels. So now, logically, they're going out. They're looking at regional UK. They're looking at other key cities in Europe, whether it's Barcelona or Madrid or other major cities, because again, there's lack of assets, and there is. I mean, I absolutely reiterate what I said. I think you'll find the extent of Asian capital is significant, but it's extremely varied. You can't compare a sophisticated REIT institutional investor like David to some of the family office capital that will take a very, very different view on assets. They also get very emotional about the investments, and if it's a trophy asset or a high-quality asset in a great location, which the chairman likes very much, you'll see a very different price being paid for that. So I think with this sort of capital, you've got to really understand the source of the capital to understand the pricing, because they can sort of go pretty wild each way, depending on how they view the asset, and the holds are long term. It's not leveraged. They're not doing the traditional sort of 5-year pre-tax IRR calc. It's a very, very different mindset, and it's very important to understand that mindset.
as Accor Hotel Invest, are you seeing more or less opportunity in Europe now than a year ago?
Well, I think we're still seeing opportunity. A lot of what we're focused on is restructuring our existing asset base.
Okay.
So that's the primary focus. I mean, there's no question yields have compressed in Europe, so opportunities are lesser than they were before, undoubtedly. But we're still finding reasonable opportunities, and you've seen from our results that, Hotel Invest, led by John's done a fantastic job investing about €1 billion last year in new real estate. So we're finding the deals, we're finding the opportunity, but a large part is also restructuring.
The ESOL view on this year actually is incredibly positive for all of us human beings, because, to be honest, for the last 18 months, there was a portfolio premium. I mean, there was no two ways about it. We used to package deals up, and because of how the private equity guys could gear up these portfolios, there was a premium. So instead of going through the traditional retail route, we were going out with big packages. And that didn't allow a lot of us to actually do much last year, right? We had to go in this search for yield, so we ended up in Newbury, But the truth is that, we look at, what we have on our agenda to market this year. It's super exciting. We have large assets in Germany. We have large assets in Paris. We have substantial quality assets in London, which we know will find a new home, a new brand, a new manager. And so we actually look quite positively to this year, because we think we're going to make a lot of new friends through this market, because there's a lot to do, and there are smaller ticket sizes, which are more digestible. Raising 600-700 million of debt on a transaction is, there's a handful of people that can do it in Europe. On the other hand, when you're hitting that 50 to 100 million mark single asset, it's an open playfield. And, again, Meridian Etoile was actually a large transaction. It's close to 400 million euro deal, but there were 20 bidders, and out of the 20, 10 we've never worked with. And I was really, really excited about it. To your question about where should people invest today, it's tricky. I think London and Paris have had such a slow performance trend for the last couple of years. I think our money is still on those two locations. If you want yield, look, Eastern Europe is great, right? You can buy 7-8% stuff in Prague and Budapest. Why not? These are quality products in international markets. And if you can venture overseas, Europeans have never really had a chance to buy anything in New York because between the 3 or 4 friends out there, they buy up everything. This year with the supply issue, maybe longer-term capital like ours can actually find a home in New York. FIRPTR is relaxing their laws around taxation. So, I wouldn't be surprised if some of your money ends up in Manhattan this year rather than in some of our gateway cities. But that's a little bit Eastel's view of things at the moment.
So without giving any secrets away, the prospective buyer of Atlas is private equity or not private equity?
It's a sovereign.
Okay, interesting. So where are cap rates today? At an Accor leased hotel in a gateway city is certainly sub 5, 4.
What are you going to pay, David? Come on.
We'll have a private chat after this.
I mean, I would really question that you can buy 7-8% even in Eastern Europe today.
Yeah.
Cambridge sub 6. I mean, I'm sure it's fair value, but that's come down a long way from even 18 months ago.
Well, Atlas again, it's a limited service brand, but that's an 8% going in. So it's a very healthy cash on cash. You put 50-60% leverage on it, you're in double-digit cash on cash. It's exciting. So we found that, but it's true. It's tough to find yield outset at the moment. Yeah.
Jojo, I think we need to speak more often. I'd love to hear this 7 or 8%.
David, you're obviously not doing the right deals.
Yeah, that's right. 5.9, and we chased after another deal in the provincial UK and found it to be closer to 5%, so we gave up. So 7 and 8% is just nice for us. Charles, if I can add on a little bit, I see the macro picture as really, actually, these past 6 months or so, the world, a bigger picture is the world is actually under a bit of stress. If you look at bigger picture, oil prices coming down, you got a China slowdown, stock market being routed, and these are big global picture, and of course the environmental issue and so on that also affecting everybody. Then you've got regional factors that's causing a bit of headache in Asia. It's probably the tension in the South China Sea, and in Europe perhaps the immigration issues and so on. So we're actually going through a stress period right now. So how does investors react under a stress situation? Firstly, I see 2 trends. One, flight to safety. So despite the fact that London or Paris and all these capital cities are very low yield, so where I want to put, not me, but my principals want to put the money, I think it's still safety first. So you'll find that a lot of capital will still go into these core markets, key markets in and around the world. And that's pulled back from what I call developing markets and so on. So that's that. But then we're confronted with a very low yield environment. And number 2, I think in such situation, you will see that there's diminishing in terms of so-called, shall I call it trophy buyers that will pay a price based on reasons other than economic reasons. So you find that investors will then come back and say, okay, I'm interested, I'm ready to buy, but then I need to see the economic returns as well. So what I'll see is that in some markets in Europe, this is my own opinion, is that in some markets the yield would hold, but in some markets...
In some markets the yield will fall?
Will probably hold. But in other markets I think you will find it adjusting. Let me take London for instance.
Adjusting which way?
Yeah. Down. I don't see it adjusting down yet. But you see, there are deals that are available in central London, for instance, calling for 3.5% cap, fully good trading performance. I don't think those deals are going to trade at all. Now you got a situation whereby investors going into London to say that, well, we probably need a headline of 5 in front or close to that. If it's sub 5, then it's got to be either locational factors or, over the next 2-3 years, I'm going to see trading beyond. But if it's, if I would call it grade B location of central London, you'll find that the deal's got to be moving towards a 6 cap.
But you won't buy. You won't buy. No one will sell.
Sorry?
No one will sell.
Yeah, so there's a bit of tension now. Just seeing that also, I think the second trend I've seen is that there's going to be, I personally felt there's going to be increase in M&A activities. I mean, Gaurav just went shopping and bought that fantastic Fairmont Raffles portfolio. And we've seen some of that happening now around the world, and the Marriott got into the Starwood thing. In Asia, right in Singapore, we have a REIT that is less than 10 years old. It's now, called Ascenders Hospitality Trust, and we read in the paper, so it's public news, I can talk about it. It's potentially for acquisition. So again, I would see more of that with the stress come about deals in a different form. Yeah, that's all.
Does your REIT, so it's a listed REIT, right? And does it trade at a discount or a premium to NAV, to the underlying value of the assets?
Right now is discount.
A discount, is that historically?
No, historically no. So our stock share prices has been better as well.
Because you hold properties in China, or what's the reason? Just because stock markets are generally down?
Stock market's generally down. It doesn't just affect the REIT. In fact, property counters, banks, is across the board. In fact, it's more sentiment. And China is a big country, and if there's a slowdown, it does affect the mood of investors, in fact. Yeah.
Do any of you subscribe to cap rates actually declining further in Europe?
By declining, you mean?
Compressing.
Compressing. Values rising.
In Europe?
In Europe.
I think it depends where.
Yeah.
So where there's demand and the psychology of the investor feeling that it's a safe haven, it's good, there's opportunity, improving, etc., then obviously it's going to compress. That's what happened in London, in Paris. Well, you've got the geopolitical risk, obviously, which is the major problem in our industry. Terrorism, anything can happen. But we know from the attacks in London before, from Paris, goes down for 6 months, it'll pick up again. But that definitely affects the yields, that's for sure.
Yeah.
So
I think it depends on the asset.
Also,
for trophy assets, I think you could see further compression. I mean, you look at New York, which is now a very tough market, 18,000 new rooms. RevPAR is under huge pressure. But, yields will continue to compress for trophy assets. You'll see another transaction announced shortly, which will put another record on a price per key and the cap rate. Yeah. So for those sorts of assets that, certain investors just want to hold, you could see, and you will see, in my view, further compression. But the general market could be a different story. Back to Europe could be a different story. So I think it's hard to generalize. You really need to look at the asset, the market, and the type of investor that asset is going to attract.
yep.
Charles, another interesting point is I feel like the behavior of the operators also has changed a little bit. They're way more aggressive in supporting capital into enter new assets where they don't have flags. So sort of maybe we see a dissectomy a little bit of that cap rate where, the encumbered assets, maybe the cap rate pushes out a little bit because of the long-term tenure. But on opportunities where you can deflag or rebrand, because you get so much more help from the operators and the owner-operators to enter the product, that obviously creates competition and a bit of yield compression. So, we do expect that actually that gap to widen a little bit in 2016, as also the debt plays into both of those elements. So probably some compression on unencumbered assets, but encumbered stabilized assets, I would argue that they've probably pushed out 50, 75 basis points from December last year.
Are you actually seeing that in valuations?
The problem with the valuations, which is an eternal debate, but valuers unfortunately look at past, not at what is going on. So what happens often is on a growing market, they value too low, and then on a falling market, they value too high, because obviously their data has to be on what has actually occurred. So we find them a little bit behind trends, and I would say at the moment, they're probably valuing them right. Last year, I think they were undervaluing them broadly because transactions were happening at probably 10-15% above where the red book could get to.
Yep.
Especially on portfolios, it was difficult because they couldn't price the premium. But at the moment, I would say they're probably in line. We on the assets that we worked on this year, which needed obviously a valuation to support the debt, valuations came in very close to price.
What are you all seeing in the debt markets? I think what we're seeing is that senior debt is still readily available. It's priced competitively, but it's the mezzanine finance that is less available and considerably more expensive. And in the US market, the debt markets have somewhat, the CMBS market's dried up, and there are some of the players are simply not lending. So less impact in Europe, but it is certainly impacting the private equity type buyer.
Yeah, absolutely. I mean, look, we are very conservative in our valuation and approach. We actually don't like to use mezzanine. It's a fact. We've had, not us, but we've seen quite a lot of issues with that. And to be quite fair, the mezzanine comes in on top when when you're betting on the market, when it's all beta. We look at alpha. Is the management going to improve above the 10% that the market is doing currently? That's the key measure. So if you can achieve something like that, then it's great. If you can't, then why do you put risk on a portfolio just to get it? Your risk is so big that you're going to, if anything happens in the market, you're going to lose out, and your investors are going to lose out, and that's it.
But on a like-for-like basis.
On like-for-like basis. But just to add also on the other point, with regards to valuation, they tend to, quite a lot of valuers tend to put in a valuation saying, oh, look at the last deal that happened. So it's not the last deal that happened. It's actually each deal is different. It's got its own capex, its own FF&E, its own price per key, where the location is, the barriers to entry, etc., etc. So each one needs to be different and looked at differently, rather than, oh, these guys have sold at a 14.4 times triple net multiple, and hence I can sell it also because it's in the UK or somewhere. So whatever that means, my 2 cents on it.
Any other comments on debt?
No. Again, incredible fan brief, plenty of availability, deposits, plenty of availability. As long as you're playing that senior, super senior, you're going to be as good as last year. To your point, Charles, you're spot on. The tricky part is that if you're going to 70-75% leverage, you need some mezzanine, even if it's on a whole loan, but then they sell it down to mezzanine. That tranche at the moment is pricing outside of 8.5, and so it doesn't work anymore. It was pricing between 6 and 8 last year. This year's between 8 and 9. And therefore, this is why our friends from the P shops are a little bit underpricing assets now, because they can't get that little extra 10% on their valuation.
Absolutely.
Yep.
But for low leverage buyers, is a fantastic market. Fantastic market.
I agree. Absolutely.
David, are you financing locally or from back home? Or not at all?
Yeah, we do make use of that. Our leverage is around 35%, and we typically would use our balance sheet to finance first, because nowadays the due diligence period is 30, 45 days, so that's not enough. So typically we use balance sheet to finance, and then we will go both banks in Asia as well as in Europe. So it's a combination of both. But not an issue. We find it that are quite readily available.
So if total deal volume in Europe last year was, 48% of activity was in the UK. Which market will be the highest this year? Still the UK?
I think not. I think Europe will beat the UK. The UK will still be pretty substantial, but look, we're working at the moment on, what, 1.4 billion in Paris alone. I'm sure you and other competitors are doing plenty of activity there too. So I'd see a big year for France. Spain doubled between 14 and 15. I think everybody would like it to see it double again. Everybody wants to go there. It's not that easy. So I would say continental Europe. Italy is a bit of always a difficult case. Everybody wants to be there, but there's nothing to buy really. So if you look at France and Spain, both of them together, they could beat the UK this year. I think.
But it takes a big portfolio.
Yeah.
It takes portfolio transactions.
You'll need a couple. There's a couple of big portfolios floating around.
Yeah.
But I think continental Europe could be able to take on UK. And if UK is not in the Euro come June, who knows what will happen after, right?
No, that's
for sure.
Let's not get into that.
But I would say definitely it's at least a lot of interest is coming for continental Europe. Big markets, better yields, cheaper debt broadly, certainly in Germany than in the UK. So I would think continental Europe's going to be, it's going to be top of the rankings this year. Yeah.
Let's have questions from the floor. Any?
Just, I'm wondering, since the bonds market is going so down at the moment, until what point do you think the yields are going to comprise?
So you mean lending costs? No,
No, the compression, sorry. How do you think that the yields are going to compress with the bond market so low? Because at least in our market in Spain, we have never seen so low yields for hotel investments.
Mm-hmm.
So it's funny because sometimes people say, hey, it's already too low. But the thing is, we have never seen this. So it's too low, we can go lower. So that's why, since you are in the whole Europe, I want to know
well,
your real opinion on this.
I mean, my view on Spain is that yields are low because there's an anticipation of.
For always talking about premium opportunity.
Yeah, no, sure. I think yields are low because there's a higher expectation of recovery in earnings, and there's limited deals available, so it's high barriers to entry.
Yep.
So I think that if there was a so-called stabilized asset in Spain, it would trade at a higher cap rate than. So I think it's all about income growth potential, and that's why.
Correct.
Because it's still, although many Spanish markets have improved over the last 12 months quite strongly, they're still way below historic peaks. Mm-hmm. So that's why I don't think 2-3% yields are here to stay in Spain as earnings improve and valuations improve. Yields will actually probably start to go the other way. But I don't know what other views are.
We 100% with you on this. Mm-hmm. I mean, friends from IREA are here today as well. I'm sure they'll vouch for the same. There is a sentiment that you're going to be hitting not double-digit growth in RevPAR, but strong RevPAR growth, especially in Madrid, which, the corporate base is significantly behind where it should be, probably for 2 to 3 years. Now, if this is reality or perception, it doesn't really matter. It's what investors think right now. And so, obviously, we should take advantage of it. But there is the sentiment that Spain's performance on the trading side has a good spell in front of them, certainly 2 to 3 years. Plus, the moratorium is interesting for buyers, right? Because they actually like the fact that supply is contained. They don't see that as an enemy at all, actually. They see it as an opportunity because you can't buy land. So, if I can get into the key assets, valuation is going the right way.
But you don't see then any effect on the interest rates being so low forever and ever. It looks like they are not going to go up who knows until when, And at the end, there are a lot of investors putting 100 euros today to receive tomorrow 99. So I think that will press all these, that's my perspective.
Yeah.
I'm not so sure.
Well, that's
The interest rates, the yields comprise down,
Yeah, I mean that's a reason to be very positive about real estate, right?
Yeah.
Yeah.
That's why you're seeing actually the activity, because obviously interest rates are lower and people are pricing in a recovery. So
Markets are crazy. The REITs are trading 40% discount to NAV. Oil is low. Put your money in hotels, man. That's the future.
Okay.
did you say you were a broker? No.
Trusted advisor. Trusted. That's what I have to say. Trusted advisor.
What you're saying is that you should enter those markets that haven't fully recovered with management contracts, obviously.
Yeah, sure. If it's a fixed lease, if it's fixed lease, yeah, you're not going to see the recovery. Absolutely. Yeah. Yeah. Yeah.
Fixed leases are bad. I'm just kidding.
What are your thoughts on investing or buying, purchasing properties in Switzerland?
Look, it's a very good question. Look, we sold in November the Holiday Inn at Zurich Airport. We actually sold it inside of a 5 cap. Again, very low yield. There, the buyer had money in Switzerland at negative interest rates, right, on deposits. So, 4% felt pretty good for him. And it's a short leasehold. It's not even a freehold asset. So, for the right asset, there is certainly appetite for Zurich and Geneva. I think outside of those markets, it's very, very choppy. But
we love Switzerland, actually. We've gone into that market, look for deals. But we just thought that the pricing and the yield is a little bit low. Otherwise, that's one of our top market that we liked a lot. And partly because I came from Singapore, so we can understand the dynamics of a well-structured market. Exactly.
Very
so
well
it's our friend. So it's definitely, Switzerland is high on the list. Yeah.
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 Agreed.
But again, the other reason for coming to Europe is actually the euros as well. It's priced relatively, inexpensive. I mean, that's one of the reasons. We do count the Swiss francs as relatively high, but that's one of the key driving factors as well. We don't underestimate that because right time to come in. Yeah.
More questions? There was the one, yeah.
Early days, I know, but are you seeing any reduction in investor interest in the UK given the whole Brexit situation and uncertainty?
I mean, I can broadly start. You want to start?
Who knows?
No, look,
We're not.
I mean,
we're not
look,
at the moment.
At the end of the day, from what we've seen, where are you? From what we've seen, we haven't seen any issues with that. I mean, some people are saying, well, what happened before the UK was outside of the European Union anyway? You already have your UK, the British pound. So it'll take 2 or 3 years to untangle all the tax laws and all this, etc. Will it affect hotels because you get quite a lot of labor from Europe and other? So, it's a tricky one. I think a lot of people are just waiting to see just after the Brexit, and it's going to come back, and I think it's going to be business as usual if there's an opportunity, obviously.
But look, we've done, a day and a half of meetings now since we're here. Nobody has asked me at one single meeting. We have 2 meetings room. We're doing back-to-backs with international capital. It's the first time we get asked this question on a day and a half. And so obviously the international capital is not too worried about it because my view is they say, well, if UK goes, Europe is going to get cheaper because I think the biggest loser of UK leaving is Europe. It's not the UK necessarily. And then that's our view. Guys, we do panels to say things that we think, right? So that's our view.
That where there's quite a lot of core people here.
It's fine, but it is what it is. If the UK stays, again, a big reinforcement of the whole European piece. So, international capital, I think, like these markets with or without the UK. So what we're maybe experiencing is that they don't necessarily want to do a deal around that time of the year. So, asking them to call for offers on a portfolio on a single asset in June is probably not going to be a smart idea because everybody's going to wait. But it hasn't stopped appetite. Again, we're on the market with a trophy hotel in London, priced, close to £1.5 million a key. and interest is as good as it was before we knew there was an election. So again, we don't think international capital.
And the pound is currently down.
From a currency point of view, it's an attractive time to buy.
Right.
Absolutely.
Okay.
Must be more.
Great.
Okay, well, thank you, panelists, and thank you everyone for attending.
Thank you.